Aruna, you're on mute.
Good evening, ladies and gentlemen. On behalf of SLIT, Sri Lanka Institute of Directors, ACCA and CFA Society Sri Lanka, a warm welcome to you all for our webinar on ESG, climate action, and the race to carbon neutral. Coincided with our webinar, today is 22nd February 2022, is a once in a lifetime day when the date numbers line up to be 22nd, 2nd, 22. Although there is no historical significance, it is a fact that this special lineup for number 2 will take place again only after 200 years. In line with these date numbers, the year 2022 will be the year for climate action, as the world picks up speed in its race against the climate change and move forward from 2021 Glasgow Climate Change Conference. Therefore, today's conversation in ESG, climate action and race to carbon neutral will be important discussion today in terms of defining issues of our time, and achieving net zero by 2050 will require a full transformation of many aspects of our economy and society. In this background, we have invited a very special panel of speakers for today's session. Representing ACCA, we have Rachel Johnson, Senior Subject Manager, Risk Management and Corporate Governance, and Dr. David Woonif, Director, International Partnership, representing CFA Institute APAC. Along with, we have Arif Misra, Head of Policy, Menasa Region, ACCA, who will moderate the session. With that note, ladies and gentlemen, I would like to invite Arif to commence the session on ESG, climate action, and the race to carbon neutral. Over to you, Arif.
Thank you, Aruna, for the introductions. And welcome to the audience. And I think a bit of housekeeping with the audience. So we've got a small panel with us today, so we'll have quite a lot of time to sort of dive into more interesting aspects of the discussion. But if you have any questions throughout the course of the panel session, you can type them into the Q&A, or you can put in some chat as well. So you've got boxes there for you to input any feedback. And today's topic, I suppose, is quite a popular topic, has been for many years now, but I think during the lockdown especially, I think the ESG debate has come right to the top of the agenda. And I know most of the audience today will be made up of finance professionals, so there'll be colleagues from the CFA Institute, from the business community, and a lot of ACCA members and students as well. So I suppose bearing that in mind, that the audience are finance professionals, I think my first question to both of you, Rachel and David, is your own views and thoughts about what do you think are the major repercussions of these ESG trends, especially the environmental trends, on profitability and shareholder value? Because we're in the accounting world and finance world, we're very used to looking at businesses through the lens of the balance sheet, the profit and loss, and the cash flows. But these trends are somewhat new to us in terms of how they impact the balance sheet and the profitability and shareholder view. What are your views on how do you think these mega trends are impacting the financial performance and the shareholder value?
Yeah, no, thank you very much, Arif, and thank you everyone for including me today. It's a great question. I think when we look at what's transpired throughout the pandemic and how it's accelerated the awareness, the impact, the severity, the panelists, we were talking earlier before we went live, just how every morning we wake up and read the paper and it's happening. And it's not only about global warming, there's all these different bags of risks that are interconnected with ESG that we can see, but how do we make sense of them? And I think through my engagement, through our members, ERIF around the world, there are inherent risks for different companies and sectors, and of course in different regions and countries. In Pakistan, we were talking earlier about it not being all about mitigation, it's also adaptation, and what they can do, what companies can do, what policymakers can do, what investors can do collectively to start looking more about activating these pledges, activating ideas, working together to find solutions that make sense, like David said with a few of his stories with his members as well. But I think from the accountancy point of view, you knocked it on the head. We've had to learn a lot about the skills that we already had and didn't know what we could do with it. So you talked about all the different, we've talked about predictive analysis, you talked about expected loss, but we need to provide more foresight with all of the information that we're gathering and sitting on, more analysis and more opinions, so the decision makers have a lot more to look at and connect and think about how that affects their stakeholders, how that affects their impact, internally and externally, as you asked in our questions earlier as well. So I think accountancy professionals, I'm just going to put something in chat as an article that I wrote recently for our magazine, AB Magazine, just about how we start thinking about the soft skills too. So how can we help our organizations develop this mindset? So there really isn't one reporting standard, there really isn't one framework. And we know there is a bit of an alphabet soup, and that is starting to consolidate, and we know there is more international cooperation. But how can we, like say today in Pakistan in our conversation, help with this policy gap and think about what are those international standards where we can help develop the mindsets needed, not just the reporting, but and also the risk accounting skills. So again, looking at the disclosures and looking what are we going to do with them, verifying them, and making sure that they're put into practice. And these are the questions that the investors, if companies small or large, want to be able to access the capital markets and retain the best, most talented staff. And we talked earlier today too, just about all the data and trying to find talent that knows how to research this data. And we're talking about data that affects everything from whether you're packaging something or whether you're in services, trying to understand the data that matters to you and your impact, and putting those from an accountancy point of view, putting those disclosures and that information that we are gathering, putting them into some kind of better type of presentation and analysis for the decision makers, so that they can embed that into their strategy and prove that they're doing it. And also, lastly, of course, see the benefits. So in this article that I've just put in the chat, it's about a bit about, as I'm sure we'll touch on a lot, all of the different moving parts. There's so many new, every country has their own kind of TCFD roadmap, and there's new standards and revisions to existing ones. And this article touches on ISO 37000, which is the first ISO corporate governance standard ever that's for all sizes and shapes, and it's an international standard. And it talks about how companies, in order to address all these ESG risks and opportunities that come with these risks, how it's important that companies can define a purpose, think about what their purpose is, but then more importantly, where accountancy comes in, help them activate that purpose and provide the accountability around it. And the thing is in this report that we did with AIRMEC here in the UK, called The Roads to Repurposing, which is also mentioned in the article, we found in the case studies that it is possible to have a purpose that's not about your financial bottom line, that leads to long-term value and long-term performance with financial gains. So I think that's where we are. And it might sound philosophical, but I think that this is where we are in terms of understanding how all these non-financial and financial risks interconnect, and how we navigate them.
Thanks, Rachel. I think just, the broader mindset that you said at the beginning. So that's one area. So, finance professionals really need to have a much broader mindset than simply looking at, the financials. So a key thing I picked up from you there. Obviously, there's a lot of data on this, and how to manage that data and monitor and report on it was another key factor coming out. And of course, the benefits, that you described as well, in terms of having that broader mindset. David, let's bring you into this. And I think, David, from your point of view, because for the audience, you've done a doctorate in water management. I think that's your area of speciality. Mm-hmm. And I think when I look at balance sheets and financials, I've always thought of the environmental impacts as somehow being kept off balance sheets. We're not really factoring the cost of our environmental, if you like, valuation or the environmental dimension. So turning to you, David, what are your views on how the environmental and social governance forces are impacting the balance sheet, the P&L, and profitability and shareholder value? And I suppose if I could draw on your work on water management, do you think this is a future cost that's going to come on a balance sheet in the future, along with carbon as well?
Sure. So let me see if I can address this in a way that's not too broad, right? So in terms of what we're seeing, like the best example that might come in immediately is carbon pricing, right? So we're starting to see these external effects of our business. So right now, emissions-based become internal through carbon pricing mechanisms that are becoming more common. Singapore, I think, just announced a carbon price of $60 by 2030. So that's something that's going to impact balance sheets directly. And I think about 3 or 4 days ago, there was another article coming out of the UK, coming out of Australia, where their largest coal power plant is going to be shut down 7 years ahead of schedule now, because it can't compete with wind anymore. So that's that transition risk that Rachel was mentioning earlier. Because they didn't plan properly for that, that's going to be a sunk cost. And what we're seeing is companies with higher climate risk face higher costs of capital and higher costs of debt. So that's going to be a direct impact to doing business. When you get back to water, like you mentioned, say, copper mining, which is a very, very big industry, uses quite a lot of water. Some of the biggest mines now are being forced to move towards desalination to meet their water needs, either from environmental pressure or just lack of local resources. So if you look into, I think it was in Brazil, the mine there, whose name is escaping me at the moment, I have it written in my notes, I'll put it in the group chat later, is going to be spending about, I think it's $2.3 billion in investing in desalination pipeline and a plant just to bring in their water. And one of the reasons they're doing that is they're actually also facing environmental liabilities. So because they've been found to be overdrawing their permits for the last 15 years, they're going to be paying for that water now. So I think it's another about $200 to $300 million in fines that they have to pay. So that water scarcity issue is becoming bigger and bigger. In Hong Kong, we're seeing that as well. So Hong Kong is starting to build desalination plants, which is going to raise the cost of water significantly in terms of how much the city pays for it. Right now, they don't really pass that tariff along, but over time, that's going to be something they can't absorb as much. So you're seeing companies here, like Swire, Coca-Cola, they're investing significantly in water reclamation technologies to kind of lower their water intensity. So it is possible in water scarce areas that you might start seeing kind of like a carbon intensity metric, but for water as well.
So we're quite, used to paying for our water, David. Just to talk about that for a little bit. So as individuals, we pay for our water that we use at our home. It may be that are installed, or you pay quarterly bills for your water. But I gather what you're saying is that that's not the true cost. So in your opinion, is that cost likely to rise in the future?
Yep. So just using Hong Kong as an example, the price of water here on a per unit basis is about 6 to 9 Hong Kong dollars. So about $1 for a cubic meter or 1,000 liters, which is about half the cost of the production. So the cost to produce the water and pump it to you is about $18 to $20. And that's only the cost for the use of the water itself. It's not really looking at what else could the river be used for. If you go back in time to 2004 and look at the history of the purchase cost of water, since Hong Kong pays for water imports, the amount that we paid for water imports was fairly linear until about 2004. And that's when you had a series of droughts that went on for about 3 years in the upriver region, which required them to shut off their hydropower production. So they had to choose between producing hydropower in that region or providing water to the cities. And since then, the cost has been increasing at about 4 to 5% per year. So you're paying that kind of environmental risk premium. Right. You can actually buy the water company on the stock market, actually. So you can see their own predictions for what they think the water cost will be. But it's generally about 3 to 4% per year increase in cost.
So all that for me represents a risk on the horizon. Whether it's water, whether it's the carbon dioxide that industrial processes are generating. Rachel, let me come back to you and ask you about these, the major risks external, that enterprises, businesses are facing, and by external, it is global warming. So the weather patterns are changing, so that's an external factor. There are emissions and waste, which are externalities that are impacting businesses. So how do we sort of really categorize the risks that companies are facing, both from these external environmental forces, as well as on the other side, the company itself is generating as well? So what two risks do you think the audience should be sort of looking at?
Well, that's what two risks? That's a tough question to just narrow down to two, because like I said earlier, the interconnectedness of the ESG risks and how that affects our, as David eloquently pointed out, our balance sheets is extraordinarily raw and there in front of us, and the way they're fast moving. So I think I mentioned earlier, we were talking about in one of my forums, Global Forum for Governance, Risk and Performance, we were talking about electric vehicles. And I think, you and David have both touched on these new kind of problems and concerns that kind of transform in the transition to net zero. So, the rising cost of materials to make the batteries for electric vehicles, the very material, as we're learning in the supply chain, geopolitical risks of where cobalt and lithium are, some countries trying to get them from other countries, and the friction between the two, and how do companies navigate these? So what I'm talking about with members in terms of getting to some sort of good answer about the narrowing down to two risks is that I'm finding that so many of our members, with even the most mature enterprise risk management frameworks, we're really shocked and stunned how misaligned their whole risk lens was, and how misaligned the different departments were, how misaligned internal audit was, across the three lines, how operations in one part of the world were with others. We've seen that with the supply chain disruption, and so there really is no point in this like green, red, or amber, because there were so many of the green ones that turned up blowing up in their face. So, risk is being transformed by what's happened and how we can see this interconnection. We see, again, like here in the UK, we had all these floods and storms that have been unprecedented, and like we haven't had for 30 years. But 30 years ago, we didn't depend on smartphones, did we? And we had power. We all had power outages here in Southwest London. And so where were you going to charge your phone? We have one car, and I didn't have our car here to come out and charge our phone. And how could I get work done, and so on. So there's all of these different types of interconnected risks that companies need to map out and understand how they affect their particular business. So the other point I'd like to make just on the risk thing, I mean, if you look at the World Economic Forum Global Risk Survey every year, I mean, they had pandemic on it, and a really, really good, and I'll put it in, and also in the chat box, is an article by a great risk influencer. You must follow her if you don't, on Andrea Bonning-Blanc, and she did a great summary of this year's risks, and it explained in her blog, the interconnectedness of them, and the lack of understanding by even the biggest tech companies, how the extreme weather, all of these were global trends building up and accumulating over the last 10 years, and the cost of the weather is put in these reports, put in the NASA reports, which are free, by the way, and we've ignored it. It's what Michelle Walker calls the gray rhinos, and we don't, whether you believe the pandemic was a black swan or a gray rhino, we've ignored them, because we did know that these are possible. And what's really scary, if you read her report, is there's just more coming. It's coming at such a fast pace right between our eyes. We're not prepared for AI. We're not prepared for the cyber implications of we must bring up of Russia and what's in Ukraine, and what might be happening here in Europe. And our members here, even some of the most technical companies, just say that there's nothing that can prevent them from being hit and incurring losses from this. It's how they're prepared, how they understand not just the likelihood, but the consequences, and that they risk budget, they have risk appetite strategies, and most importantly, which I hope I don't go on too much, which is my passion for this year, is culture, and how we can help, how we can help build more risk robust cultures. You mentioned, Arif, just about, the financial professionals working together, that collaboration and that accountability, and setting the tone from the top. But there also has to be the front line, the first line. They need to understand what their purpose is. What if they break a law, does that mean the whole business could go down? It's not just them losing their job. So the implications, and knowing what the company's risk appetite are, what their processes are, what their whistleblowing policy is, and making sure that risk is in all of the conversations. But I really do urge you to read this article, which I'll put on now. So I hope I didn't disappoint you with not giving you two risks, but hopefully a bit of two bits of food for thought.
Yeah, maybe I could add on a bit. So like you were mentioning, the interconnectedness, one example I think would be 2011 Thailand flooding, where, if you're a company in Japan, does flooding in Thailand really bother you? And the answer was yes. There was $2.2 billion in insurance payouts in Japan due to business interruptions because of flooding in Thailand. That took out 10,000 factories that Japanese companies were dependent on for textiles or automotive parts. So, not knowing your supply chain risks is definitely a problem. Another example I actually got recently was during a class that I was sitting in on, where they were talking with ESG companies in China and giving them potential solutions. And, say you're too focused on the E or the S or the G, that can give you problems in your other two categories. So one example was for lithium mining. They had suggested building the mine in Brazil instead of in China because they could use a different mining method, which was less environmentally damaging. But moving the mine outside then creates social problems with, well, what about the jobs that you've now exported? So how do you fill that hole with the workforce that used to be local that now you've sent overseas? So focusing on the environmental dimension can create a problem in your social dimension.
Yeah, and all those interconnectedness that you described, David, the finance professional will sort of try to sort of quantify that in monetary terms, and say, okay, well, if I'm making these decisions, yes, there'll be social consequences, there'll be environmental consequences, but I have to look at my bottom line, and I'm reporting on my financials and my earnings per share or my PE ratio, and therefore the finance professional is faced with this huge sort of now pressure that's building up on sort of how to connect those things with the monetary value. A lot of what we've described in terms of risks, etc., are very hard to quantify. So the risks that Rachel described, transition risks and geopolitical risks and systematic risks. What do you think the finance professional needs to know about playing a role in mitigating those risks and adapting to those risks? So what could the Japanese buyers of the Thai merchandise or their goods, what could they have done to mitigate against that or to adapt to it?
Yeah, it's possible that, I'm not sure what those companies were doing, but that gets into the traditional setup of how do you really do your risk analysis. So did they do a climate analysis that said, what if there's flooding? Or what if global temperatures go up 1 degree? How does that affect my supply chain? And then what's the probability of a 1 versus a 1.5 versus a 2? You could start building those climate scenarios and saying, what are the potential impacts at each of these different degree points? So if flooding is going to be 30% more common, how does that affect my supply chain? Or how does this affect the ability to get shipping containers like we've seen with COVID? I don't think anyone saw that giant increase to shipping costs. But maybe if they had done a full systems analysis, maybe instead of looking just at the what's the best way to phrase it? I think a lot of analysis tends to be outside looking in instead of inside looking out.
Yeah.
So it's kind of reversing the way they tend to do their analyses might give them some more insights in that regard.
Yeah, we're seeing that too, Arif, in our engagement, PR and professional insights with members, just about how to incorporate more scenario analysis and how to optimize those inputs and outputs. So I totally agree, David. And that is a big area we're working on, where we're starting a series of workshops that start next week, first in the Middle East. I think it's, again, that it isn't this one size fits all, but it really is looking, it's all about collecting this data. It will be littered with assumptions, but just going through and looking at, more than probabilities, looking at how you can plan for the consequences, like your Thai flooding example, for sure. I think, companies, they're really struggling to understand what emerging risks are and what they can do, because as Arif pointed out in the question, we're talking about intangibles, and I'm sitting here on behalf of an accountancy trade body, and I'm telling you, even the best of us that are almost afraid of him. This is a big challenge that we're working with our members. to be less fearful about it, and to just keep going with all of the data, sharing information across the teams. I've talked to so many of our CFO and CRO members who never really talk to each other unless they had to before the pandemic. And I'm talking about big banks, big, very profitable private banks. And when they put their two heads together, and I mean, seriously, with all the different scenarios, they were able to make some sense of it and plan better.
So I think, all these things are extremely important for the audience. And I think, Rachel, you mentioned that a more scenario-based analysis to factor in ESGs may be a way for finance professionals to broaden that sort of risk appetite of theirs, and look at things on the horizon which they currently probably are not looking at, but need to be aware of and to factor in. Let's move on a little bit and talk about these stakeholder groups. And one obviously, with CFA participating, one of the most important stakeholder groups is the investor, whether as an asset owner or an asset manager, a money manager. Increasingly, we're seeing that conventional corporate analysis now is supplemented or a great deal now by ESG analysis as well. So ESG is not a specialized niche now. If you go to a company, you're going to have a sort of a checklist of, your traditional orthodox financial analysis, but also a list of ESG questions as well. And therefore, to score and rate that company in terms of, are they viable for the portfolio or not? David, why is this sudden surge in investor interest, in ESG metrics? Coming now to the very top of the agenda?
That's a good question. I'm not sure I'll have the correct answer for this one, but I think one of the reasons why you're starting to possibly see more of these surveys is just to standardize the information everyone's getting. There's so many different avenues to get these. If you want to just go through, like, say, MSCI or one of the other, like Morningstar, everyone's going to rate their material differently. So if you're an investor,
what's MSCI for the audience, David? What's MSCI?
It's the main rating. I can't remember exactly what it stands for, but that's one of their main rating agencies that is putting out your sustainability labeling on. Right. Yeah. So it's just one of the big rating agencies that will tell you the ESG performance of the companies that you might be investing in.
Right.
So as an individual investor, you might want to get that information more directly, because if you're getting it secondhand off the market, you're not necessarily knowing if they're answering your questions directly. That's one potential reason, but.
So would you then go directly to the company, a target company, to get that more information?
That's the way I would do it. At least in the Chinese market, we're seeing quite a lot. There's not a lot of mandatory reporting, but if you look at the two main reasons why companies are starting to report, the second one listed is investor interest. So the companies are feeling a lot of pressure from their investment groups, especially in the Chinese markets, to start reporting this information and making this information publicly available.
And just for the sake of interest, how do you overcome some of the language barriers when you are doing cross-border sort of, analysis?
Yeah, that is tricky for me. Usually for me, I rely on people with more expertise. So for me, I have people who do my translations, which makes my life a little bit easier. So for like the CFA Institute, we have our society in Beijing who really understands the Chinese market and deals with them directly, and then they pass the information on to us.
Rachel, you want to come in there?
Yeah, I've done a lot for us, Arif, in this space. In fact, I was helping our colleagues in Singapore just before the end of 2021 on Singapore stewardship principles for responsible investors there, and we provided quite an extensive comments for their revisions, and it is really interesting. You're right. To me, from an investor perspective, they've been the first sort of bit in this collective action, raising their expectations for companies. And, of course, started with oil and gas and then banks and now, moving on so rapidly. It's not a trend anymore, it's mainstream. And, coming from an accountancy point of view, we have members in all different types of roles, from the risk finance teams, back office, NEDs, and CIOs. And an interesting market, I think, from this point of view, is Vietnam. The language is really difficult, but it's been one of the best performing stock markets throughout the pandemic, even though they were hit hard by Delta, for sure. And I've been engaging with a lot of our members there over the last 18 months, who mostly are in finance teams, not so much audit, but more on the finance teams. And they're young and in some of these like really fast growing companies. And it's really interesting. They are younger. They have these values and these aspirations different than the generations before them. And so they do think about the E and the S. But you're right to ask these questions, Arif. It's about how do you communicate them, and how do the investors who want to reap the benefits, who say that they are a responsible investor, how are they engaging, and how are they really flexing their role as stewards, to help the country progress, because they're going to be one of the hardest hit impact by climate change and all these climate risks. So I think that, the PRI signatories, there are about 15,000 now around the world, and there might have been, I don't know, not even 10,000 5 years ago. That gives you an indication. And, they started over 15 years ago, and that gives you a little bit of indication of how rapidly they've investors who are serious about it are applying to be a PRI signatory. And a few trends, if you don't mind me, mentioning that I've seen, is that the PRI signatory have also had to, along with investors and the MSCIs, the stock exchanges, the rating agencies, all the equity indexes, that have all of these, they've all been raising their expectations to try to prevent greenwashing and make sure that they're investing in something that they've been told they are, but also the investors themselves. So back to the Singapore stewardship principles, it's not just about your portfolio having a low carbon, lower footprint than, say, the benchmark index that you're investing against, but also investing in the right solutions, the investing in the ones. There was a question here in the chat about how do you balance the E and the S and the G. Well, this is the stage we are in this rapid evolution of ESG investing, is that there are going to be companies that have a high E but treat their employees horribly, and there's a lot of American companies, not that we can talk about that are in the headlines, and so therefore they get knocked out of some of these portfolios. On the other side of the coin, we have a lot of investors that have baddies, that keep those baddies in their portfolios because they're still making a return. And then they get called out, and they either lose their own customers, they face reputational risks, and right in the front page of the Wall Street Journal. So there's just so many aspects of this as it evolves fast too. But I think, just to end here, is what both the panelists have said, David and Arif, is transparency is key. And being able to verify that, and again, from our perspective, is having those proper, if you're an investor, having those selection processes and criteria very transparent and clear, so that the investors themselves and the customers of those companies can see that clearly. And I think that also, from the investors' perspective, their duty to make sure that they're helping to progress those companies, particularly and there are some really great examples in Vietnam, in the VNAS, and those Vietnam companies that have become allowed more international directors on their board and have partnered with more, in the supply chain with more foreign investors too. They have been able to help with the language barrier, and they have had better engagement despite the lockdowns and working from home, and been able to successfully grow and adapt, as you say, and repurpose.
So let me at the same time try and address some of these questions appearing in the chat so we can get the audience engaged in this. One of the questions from Abu Muwahib was, what is the risk in self-generated water versus external third-party supplied water? I suppose that's for you, David. I don't really know what self-generated water is.
Sure. So I'm not sure what he means by risk exactly. So I'll go over a couple of different parts. So a third-party supplied water would probably be, in most cases, municipal, or you're getting it from, I'd imagine, the local environment, possibly, if you're thinking of the environment as a third party. So if you're getting it from municipal supply, the risk there would always just be, you don't have any control over the production or the cost, right? So you don't know what they're going to do with it in the future or how they're going to charge you. For water you produce yourself, it's traditionally more expensive, but you have full control over it. So in a way, it's a riskless supply, right? If you're manufacturing water, you know your capability and how much you can get. The risk there then just comes down to, do you have the employees? Do you have the space? Do you have the expertise to do it? And the risk will be different depending on different sectors. So if you're a mining company, there's not much risk for you for using your own generated water. A lot of them use seawater or desalinated water to avoid using local water. If you're a food and beverage company, there's a bit more risk for you because you got to make sure if you're producing water, it doesn't end up in your product. So if you're a Coca-Cola and you're using recycled water to clean your bottles, you can't use it to make Coke as well. It's not generally accepted by the public or by regulation. So if you're going to make the water yourself, you have to make sure you're in compliance with all local regulations wherever your companies are.
Yeah, that's a very good point. And just on that, let me just dwell on that for a second, because I'm trying to think of the connectivity between, climate action and carbon neutrality and water. But water seems like much more of a localized sort of a resource, where you're talking about either like here in this part of the world, glacial melt is one. I can see the connection between glacial melt and global warming. But are the two connected, and is there a strong connection between the two?
Sure. So there's kind of like a three-way connection there. So you have your food water nexus, but you also have the food water energy nexus. So if you want to make food or you want to make electricity, you need water. If you want to make water, you need electricity. So depending on how you make your water, you're using a certain amount of electricity. So here in Hong Kong, I can't remember the exact math. I got to go look at my notes again at some point. We'll say it takes 1 kilowatt hour to produce 1 cubic meter of local water. If you want to then import water, there's a bit more electricity that's used because you have to pump that water some distance. But when you get into desalination, it's about 4 to 5 times, so 4 to 5 kilowatt hours. So you're going to use significantly more energy with the technology that they've chosen. I know Singapore has been doing a lot of research on these topics as well, because they're very reliant on water desalination and water reclamation. So they're trying to get that down to lower their emissions. You also have their in-between water, which is like your water recycling. So it's a second kind of tier of water. It's generally not drinkable, but you can use it in your industrial processes to offset the need for fresh water. And that's becoming much more common. Singapore uses it, I think, for 20% or 30%, and they're trying to get it up to 40% of their water supply. They basically want to offset all their industrial water use, or they're all non-potable uses, to preserve as much fresh water as possible for consumption.
Right. So that brings me to another point. Again, bearing in mind that the audience is largely finance professionals, I'm thinking about materiality. So when accountants and finance professionals are looking at financial reports, they're looking at what is the most materially relevant aspects of the financial performance to the reader of the financial statements. If I want to make my buy or sell decisions on an investment, I want to know about the most material aspects. I want the company to quantify that and report it. Now, with ESG, perhaps which one of you wants to have a first stab at this? How do I now sort of distill out from all the ESG factors what is material to the investor? If I'm a chief executive and I've got a little cactus in my room and I water it every day, do you think that my investors want to know about the health of my cactus and how much water I'm doing? Should I be reporting on that? What should I be reporting on?
That might be one Rachel probably can answer better
I
than
can
me.
start. I can start. I probably should have thought about this one more and put it into something, bullet points to think, because I'll probably miss a few things. First of all, in terms of again getting back to when you asked about the two risks, it really, there's never going to be an answer that's right there for this question for any company. It's really this is where accountants come in again. I see there's a question there from Rizwan. This is where we come in to help set those key KPIs, key performance indicators, and KRIs, key risk indicators, and I say key. So this is when you do these materiality assessments, where you find what are these consequences, these threats, what are going to be the financial impacts of those. And again, we found that those that were in the green level, or those that were just not addressed because they were considered non-financial risks, have proved to be the most material throughout the pandemic. And we're talking not only environmental, but even more so, and you'll see in this year's WEF global survey, social, mental health. So many of our board members have told me, whether they're head of the audit risk committee or the chair of the board, that the mental health has been the biggest struggle for them risk-wise. They just simply don't know how to deal with it. And it's
what does that mean, Rachel? That we would have to report to an investor on the mental health of the board of directors, the chief executive?
There is a lot of proposals around the world and in different ones about how you treat your employees and how you measure performance. And there's a lot going on at the moment that I'm working with in this special interest group on behavioral science. And there's just no policymaker or company board in the world right now that doesn't have health and safety at the top. If they don't, good luck. And in the material effect of the mental health, I can think of lots of different examples of real estate company, massive real estate building company. If they weren't able to make furlough here, their families were really struggling. Our food bank lines were out the door, and companies were struggling financially to be able to try to help them. And then when they do lose someone who's really important, there was quite a lot in the city. So a lot of asset managers here, their CIOs, just lost it because of lockdown. It was just an unprecedented situation. And that had a major material impact. And so the finance teams, the back office teams in these asset manager firms, interestingly, there's been a lot of engagement I've had with our members there about trying to answer the question you're giving and you're posing. It's not easy, but it's an intangible risk that accountants need to step up and not be so scared about, and try to even with assumptions, just get better at it as they go. One of the members on my forum talked about, these valuing intangibles, sort of like how the food industry did carbohydrates in like the 80s on Coke cans, and how they were so inaccurate at first, and now they are. Now you can bet your money that you're getting the exact amount of carbs that they say there are on the can. But 20 years ago, when they first did, they were all over the place. The other thing I would mention too, Arif, is due diligence. This is a huge part of what will be coming out in the European Commission Sustainable Corporate Governance proposals tomorrow. And I think David touched on this with all his great examples, is in third party and supply chains. And this is where even the best, like Apple's, just didn't do the due diligence that they thought they were doing on paper on this framework. So I think everyone's having to invest a lot more in knowing their customer, knowing their stakeholders, knowing who they're doing business with, trying to understand what they're compliant to in their country, just understanding everything that their third parties are involved in and associated to, and what they're obliged to do regulatory wise, and look and find out whether they're doing that or not. And again, this is just it's not just in technology, and it's asking questions, asking really hard, uncomfortable questions, and doing everything you can to dig up and get the answers that you need before you make that potentially wrong decision, bad decision.
So David, if we've got members in the audience who are perhaps working for financial services, they're working for a bank, say, they're probably thinking, well, the banking operation's not really, the water footprint of the bank isn't really vast. There's no reason for us to report to the stakeholders or the shareholders of a bank on what our water footprint is. But they could very well have, hundreds of $1 million loans out to companies.
Yep.
So, again, your views on materiality, where does it start and where does it sort of end?
Yep. So I think materiality is very tricky, because what's materiality in 2018 might not be material in 2019. And a good example of that was, say, McDonald's, right? In 2018, their CO2 emissions are material. In 2019, for some reason, their CO2 emissions were suddenly immaterial. And the question is, well, why? And that's because in 2019, there was more focus on potential legislative action on them in Europe because of their the waste generated by their packaging. So there was more focus on how are they going to manage that risk. And because they're food and beverage, their scope 1 and scope 2 emissions are quite low, so they're not material this year. But if you suddenly had a $100 ton carbon price, perhaps they'd suddenly become material again. When you look into the TCFD, what they consider to be material, they say you shouldn't report anything that's not material, but then they go on to say you should report certain things regardless of materiality. So, if you want to be as transparent as possible, you should be giving as much information as possible to your investors. Even if it's not necessarily, in your opinion, material, it might be material to an investor who has a specific investing style, or maybe a more complete amount of information. And I think Rachel mentioned earlier with the PRI, if you look into the PRI, they have their own engagement dynamics that they think people should follow. And I think that's the communicative, learning, and political. So dealing with how knowledge is exchanged between companies and their stakeholders, how that knowledge is enhanced, and what relationships they build together. So, leveraging that annual general meeting, I think BlackRock does a really good job of writing their letter every year and saying how they're going to drive companies to change and what information they want from their companies. So, if you're working for a bank and you have these huge investment portfolios, how are you using your investment in those companies to drive change? Because with the Singapore thing, they put out their target recently. I was looking through Temasek and investment doctrines, and Temasek actually doesn't set a carbon target for if they'll invest with you or not. Instead, they say, do you have a path to net zero that makes sense? So they don't really say, we're going to invest on you based on your emissions. They invest on you based on, do you have concrete plans? That's their style. Other ones are more, we're just going to invest in low carbon, which is a very different style. So depending on what kind of information you want, that's how you should be driving your engagement.
Mm-hmm.
So let me thanks for that, David. Let me try and ask some of these questions appearing in the chat as well. At the same time, both of you have mentioned TCFD. You've mentioned, there's Rachel mentioned that there's a whole alphabet soup of standards out there, GRI, SASB, they go on and on and on. And now there's ISSB as well, which is sort of the IFAC one. But none of these are mandatory, at the moment. A lot of, they're all voluntary. So, and then David, you mentioned, well, if I start disclosing my scope 1 and 2, I could lose competitive advantage, or I may face litigation.
Yep.
If I do disclose, if I am transparent, I may, face some litigations from a group of concerned people. So why, all these listeners who are finance professionals listening to you say, well, why take the risk of reporting? Yeah, I could lose competitive advantage. I may face a court case, etc. So why do it?
Yeah, I think this might be let me see if this story is relevant or not. Ages ago in the US, back when we had glass bottles for everything, right? Now everything's recyclable. But back in the day, beer used to come in glass bottles. They'd send the bottles out, and then when people drank them, they'd bring them back. And everybody steam cleaned their bottles, but the general public didn't know it. So one company just started putting out an ad, we steam clean our bottles. They just said nothing else, but it created the public perception that nobody else did it. So because they were the first ones to come out and say, here's everything we do, it creates the perception nobody else did it. So if you're transparent and you talk about what you do, you put pressure on your competitors to start putting out that same information. Because there's questions of, well, you might lose some maybe immediate advantage. Maybe your emissions look worse. Say you report all your scope 3 categories while your competitors only report 1 or 2 of the 15 available scope 3 categories. The question starts becoming, why aren't they reporting them?
Exactly. Yeah, I mean, if I would echo David, I totally agree, and that's a great example. Again, I mean, the other side of that, Arif, is that if they fail to not address it and report about it, they'll never be around. How are they going to access any kind of financing? How are they going to retain staff? How are they going to, you're working on this great ESG think tank there, and you want to try to get some scoring going. How are they, if there's no information about how they're dealing with all these existential risks, how they treat their employees, how they value their impact, and then they're not going to be able to retain customers, let alone get a loan, or even a mortgage or rent a building. This is the way the world is going very fast. And back to sort of like I don't want to say European Commission and Vietnam and all the same ones, but I forgot to mention that similar to what you're working on, Arif, here in Pakistan with Lahore University Management Sciences and the ESG think tank, and getting some scoring going to help get more information about Pakistan companies and how they can benchmark and how stakeholders can access this information. ACCA, we've been involved in something similar in Vietnam called the Vietnam Business Integrity Network. And again, just before the end of last year, ACCA, we were on the advisory board, and we were helping them put together some scoring. And there's definitely going to be some companies that leave things blank, but they will eventually be the ones that fall through the cracks if they don't start providing this information. But we're trying to work with the government and other partners, like we're doing today with CFA and IOD. SLID is to try to help those companies learn how to do it, and to get some of the best examples out and start getting up a benchmark index. And also, we didn't touch on something much yet, is the 17 SDGs, and I think that's another free thing that's right there to look at which ones are most key related to your company, your organization, and your impact and your purpose. I mean, I know here at the ACCA, I think we've done Arif will know more. I wrote them down. I think 4, 9, definitely 17 on collaborating is my favorite one. And I think that's a really good start for companies that feel lost, is to look at those and then write a plan around the ones that, matter to them most. And, here in the UK, I was helping one of my colleagues who is like Arif in Pakistan on a program that the government was doing on social housing. So trying to get the housing associations to follow a new, very basic framework to the ESG framework. And it was really interesting. We had, again, members from all different sides of the housing market, housing society market, and at the banks, the high street banks too. And a lot of them who really spoke up and were honest said that, they just kind of took it one by one. It was a journey. And each time they kind of picked the first one they thought that mattered and learned how to do these materiality assessments, learn how to do the physical risk assessments, learn how to get information and that they need and explore and dig what's available out there from government agencies and so on. Then once they got it, they realized like just how much better they're operating, their bottom line, their less disruption, less things going wrong and going down, and how much more the banks are willing to give them more money so that they can keep improving their facilities.
Yeah, thanks for that, Rachel. I think that obviously if you're not reporting voluntarily, you're really setting yourself up from losing that competitive advantage that David talked about, but you're also going to gradually, move away from any future capital allocation that may go your way as well. So I think all these future long-term capital allocation decisions are going to be based upon greater accountability and disclosure, and obviously, customers who are, people who are really your sense of purpose is your customer and their needs are also going to be met by meeting a lot of these commitments to climate change and also to society as well. So let me go back to the chat. I want to answer Abul Mawahib's questions. He says, how do you set a target for carbon emission? Simple question, but I think better to communicate it. And how do you measure your current status of carbon emission? Is there, David, is there a simple way we can just communicate that to people?
Sure. So it's going to depend a bit on your industry. There's a lot of ways to set a carbon target. You can go for, do you want to be best in class? So do you want to say, look at the top 10 people in your industry and say, what are their targets? In terms of your own carbon emissions, you have the scope 1, scope 2, scope 3. If you don't have much knowledge, it's best to start with scope 1, scope 2, and then work on your scope 3 over time. That's the most complicated, the most difficult. And you can set a baseline year. You want to find a normal year. You can even do this year. Well, I wouldn't pick a COVID year. That's not going to be a very good baseline year. But you want to pick a year as your baseline, look at your energy use, look at your other kind of what goes into those buckets, and then use that to set your reductions. There's a lot of different ways. If you look into like the NDCs, there's 4 different methods for setting your targets, and they all have kind of benefits and drawbacks. So you want to pick the one that fits your business the best. So you want to do a little bit of research before you just start putting numbers out.
Right. And then I assume these agencies like CDP, you subscribe to them, they send you a questionnaire, you answer the questions, and they come up with your carbon sort of status at the moment, your carbon footprint, but they also tell you within the sector who are the best performers.
Yep. So the danger though is the less you know about your operations, the more you're going to assume. So, when I do an LCA for somebody, I want to get as much of their actual data as possible. Otherwise, I have to use average data.
Right.
And that average data could either very highly understate or very highly overstate your emissions. And say you do, you don't really know where you're sourcing your plastics from, you don't know much about your electricity source, so you use local estimates. And then you find out you're off by 20%. If you had set an absolute emissions target to go down by 20%, now you have to go down an additional 20% that you didn't expect to have to do.
Yes. Right. Yes, absolutely. Good point. Thank you for sharing that. There's another question here. It says that I believe during COVID-19, the focus was on community engagement, employee engagement. Definitely very much the case in our organization, Rachel, on employee engagement. What is the measures now, how helping hand to customers and employees and society? Is there I can't really understand that question. What is the measure? I suppose they're looking at, again, scores and measurements for employee welfare and customer welfare.
Yeah, I mean, I think that all organizations around the world are, getting back to the points we talked about in mental health and managing all of these trends and transitions that have happened so fast that we're existing, but we're just accelerated by the COVID-19 disruption. It's a new world, and therefore new workplace cultures that we're dealing with, and people are our best assets and our biggest risks in that regard. And so I think, the last 2 years have given employee engagement, stakeholder engagement, a whole new meaning, really. So when I'm talking to, I was telling David and Arif before we went live, I was speaking to another interesting risk guru who's on our special interest group on risk culture called Horst Simon. It's worth following him on LinkedIn if you haven't. And he actually works with quite a lot of companies in the Middle East and South Asia. He's talking how he's dealing more, he's comes from the risk field, but he said that risk, just calling someone a risk manager anymore is just the wrong thing. And he said he deals more and more of his consultancy work with HR and how HR really has understood how do they engage, how do they protect, how do they meet the needs, how do they communicate with them, there's a lot that we'll be talking about, and just the hiring process and doing your due diligence on that. I've actually talked with some of our members in Pakistan about that for my report last year. There was one member who's a CRO of a microfinance bank in Pakistan. He was talking about how he put all these metrics together years ago before the pandemic, and put in, his boss was like, why are you talking to HR? And he says, well, if our people aren't doing the work that we ask them to do, or if they overlook something or make a data breach, do you know what the cost could be? People are our biggest risks in terms of looking at doing all the due diligent process and doing what we ask and making sure. And then he even was able to prove how much he saved them after creating those metrics than before. And you think of like fines or money laundering and, or defaults, customer defaults, or like just even one thing that Horst was talking about yesterday is, again, with all this great resignation, is the employee retention. I mean, recruitment costs are really high. Onboarding costs and the processes is very time extensive, labor extensive. So there's the member who asked that question. I hope I addressed it right, but it is a really good question, a very topical thing. And I guess the answer is there is no right answer, but it's that you need to give it attention and it will pay off.
Yeah, thanks, Rachel. I mean, looking at some of there's factors that come under social, and when when the audience is looking at its own organization, you can look at the human rights aspects of your organization, both directly and within your supply chain. And obviously, in developing countries, this is a really critical area. Modern slavery is another one that comes under social, child labor, working conditions, and employee relations. All of these come under the pillar of social. So, I think, and there are organizations that also rank these indicators as well, so through questionnaires, etc. But again, like David mentioned earlier on, that you can't really rely wholly on these agencies. You have to go in and ask them directly and gather your own proprietary sort of knowledge on that as well. Looking at down the chat box.
Yeah, can I just say that was a good point about the human rights, and that is another big thing that has been a big bone of contention with the European Commission's comments and consultations about the due diligence of third parties in the supply chains when it comes to human rights. That was a huge, and what the European Commission originally proposed was like making it legal. So the companies that didn't do their due diligence on companies in other markets that were using child labor or child slavery or women's slavery, all these things, that the company that was using that company would be legally liable. And I do see this as countries around the world are really working together. If there's one thing they're working on together, is fighting ABC, anti-bribery and corruption, and the human rights. So you're right, the S in the ESG is right up there, and companies are taking it seriously because they do not want to be held liable, and of course they don't want their reputation risk either and be caught out.
Yeah, thank you, Rachel. I've got another question here from Ahmed Hussain. He's got a specific question to Pakistan, where what's your view on ESG reporting? How will ESG reporting be implemented in organizations? And he's interested in any research. Well, I mean, if you look at the genesis of financial reporting, you've got global reporting standards in the shape of IFRS. You've got global auditing standards in terms of international standards of auditing. So, it's a very scientific sort of architecture for financial reporting. For ESG reporting, there's, as described before, there are many codes, there are many standards, lots of frameworks. So there's still a rationalization process going on now. I think within a few years, I think it will be much more rationalized. It's all coming under the umbrella of the ISSB increasingly. And a lot of the codes, they're all aligned together. So they know, when they're developing these codes, to align them together. So I don't think there are any material differences. For example, I read somewhere, if you comply with TCFD, you're wholly in compliance with SASB as well.
Yes.
And you're probably also partly in compliance with GRI. So there is, some alignment coming through, and I think we have to wait for that. In this part of the world, it's not mandatory at the moment. In MESA countries, there's no mandatory ESG reporting at the moment. It's completely voluntary. But we have seen, like David mentioned, we have seen companies engage in voluntary reporting just to get that competitive advantage, and just to make sure that they're secure for future capital allocation. So those are very valid reasons to start reporting. Any other questions here? I did see how hard COVID impacted the insurance industry. I'm currently in insurance sector as an auditor, but then again, what is the regulator outlook on these issues? So insurance, I suppose, if it's your regular insurance premiums that you've got on business continuity, I imagine with all those risks that David and Rachel have mentioned, physical risk and transition risks, your insurance premiums are going to go up, aren't they?
We didn't even really talk about liability risk today either, which is a completely separate topic in a way, but also very well connected.
Yeah. Well, we talked about litigation, and litigation therefore opens you up to financial liability.
Yeah.
You know,
well, also,
yeah.
Just like in Texas this winter, I'm sure you're aware they had the massive freezing where the power companies were shut down. That was actually in the courts not considered an act of God. Normally in Texas, that kind of freezing, the companies thought it would have been covered by their insurance policies, but the courts decided they've known about the climate change aspects for so long that now that they've taken no action for so long, it's no longer a force majeure.
Right.
So that's just, that was not a liability they expected to have, but their inaction on climate is now considered to have basically revoked their insurance policies on that incident.
Right. So that's a very interesting point. I mean, because as the science becomes, more and more true in terms of the empirical evidence, and if you continue to ignore that evidence and say all of these things that we've mentioned up to now are acts of God, you're saying, they're no longer. If you should have premeditated all these aspects, and you should have taken action.
So that gets into infrastructure questions. If you built infrastructure in a place that is now prone to flooding, but you haven't updated your flood maps in 30 years, are they going to be covered? How that kind of business as usual, like we just keep rebuilding in floodplain or hurricane, that might have to change.
Yeah. Very interesting. Thanks, David, for that. How the carbon footprint issue impacted rapidly in oil and gas industry, and whether it would be continued in the long run. So I'm assuming the Nipa Hazra has asked this. I'm assuming she's saying that the carbon footprint has obviously fossil fuels and its scientific evidence that fossil fuels are creating global warming has impacted the oil and gas industry, whether it would be continued in the long run rather than thinking about transforming energy. Thank you.
Yeah, I think that would be a long run continuance. I mean, that's been going on for years now, that shift away from oil towards at least natural gas. And now, renewables out competing certain fossil fuels has been a big issue. And this is even without like carbon pricing really factored in. We haven't seen that $100 a ton carbon price anywhere yet. So I don't see this going away in the long run. I think things like natural gas, nuclear will be around for a long time, possibly paired with hydro. I mean, in China, hydro is the second biggest source of electrical energy. So hydro, wind, solar, those have other issues that you get into as those become a larger part of your grid. Then you need to start having more changes to your other infrastructure, battery storage or some kind of storage. There's a lot of science. There's a lot of science and infrastructure that needs to kick in once you start getting towards like 25% renewables in your grid. So those are discussions for further down the line, but those are not going away anytime soon. Solar, the cost of solar has come down about 80% since it came out. So, it's just going to be cheaper than the fossil fuels in the future.
Yeah, and making those changes in from a public policy and corporate point of view is, we talk about in my forum all the time, is about looking at it as value creation, not expense. That's so important. I put a few things in the chat box too, Arif, that from PI and AB Magazine that touch on all of the things you were mentioning as well for the audience.
Yeah, here's an interesting question. I mean, we all know about electric vehicles going to significantly reduce carbon footprints in the automobile sector. And any sort of reliable research in this regard? I suppose there's hundreds. If you just, Google it, there's bound to be hundreds. But again, I mean, it's not the only mitigation technique, is it? Using,
No.
you have to think up many sort of innovative ways to. I mean, we keep hearing about the biggest contribution to global warming and is agriculture and livestock. How are we going to, this Middle East and South Asia is a country of meat lovers. They're just the livestock population is huge.
Yeah, well, so is Hong Kong. I think we have the highest meat consumption per capita, I think.
Yeah.
Really?
So, yeah, it's pretty high. We're above Brazil, which is interesting.
Yeah, that is interesting.
Yeah.
So I think the answer to Adil Rahman's question is, yes, it's going to make an impact, electric vehicles, but then one can go into all the energy needs of that particular sector to actually make the batteries. And you heard about, lithium and all those things as well.
Yep. Yeah. If you do a little bit of like searching around on kind of like the more academic side, there's quite a lot of papers that dig into this topic. It's a complicated topic. So the question really isn't carbon footprint. Obviously, electric vehicles will have a good effect on the carbon footprint going forward. The battery issue, the carbon footprint of the batteries is quite high, especially if they're older, and it depends where they were made. So there's a good paper from the European Union that goes over how to mitigate the battery lifetime. So going into its second and third life, the batteries should not go from your car to a landfill. The batteries need to go from your car to, say, the commercial sector, where they would then be used with emergency generators to provide backup power, or to homes to act as power walls, and then eventually to a battery recycling system. Unfortunately, those battery recycling systems are not very advanced right now, especially in Hong Kong. I don't think we have any. So, as the Tesla batteries start decaying over the next couple of years, the question is, what are we going to do with them? But, as we green our electrical grid, that's going to be an issue. If you're powering an electric car in the Netherlands, it's got a much lower carbon footprint than an electrical car in China. So it is a bit of a complicated topic in terms of landfill for the batteries, those recycling systems, et cetera. But that's still about 4 to 5 years out before that'll be a big kind of topic.
There's one for you, Rachel. Is there going to be a global green taxonomy on the horizon, or?
Well, I think I sent an article, if you look up, that just was out in AB Magazine about ISSB's sustainability proposals. And, yes, that is the plan. I think the whole idea is to try to, as we talked about earlier, try to, these building blocks, these alphabet soups is trying to consolidate and make it more cohesive for organizations. I think the other thing to just kind of remember too about all these things I'm sending, like I mentioned, the ESG guide, is all these frameworks, the ISO 37000, when you read that other article too about purpose and creating value, they're not meant to be plugins, and there's just nothing about anything we've talked today where you can just like download and plug in and think that, okay, and hire someone with a title that has sustainability or risk in it and think, okay, now we've got it. They're meant to be guides, and it does take a lot of thinking through of how you can make it work for your own company. I think the message is clear today that if you don't get on this and make sure that you report and have a strategy and are able to verify it, then you're going to miss out. And I hope that everything that we've been saying was useful. I was just going to ask, since David's the expert and doctor here, is just I do think agriculture, I'm really interested in it, and I talk about how, it was a big thing at COP, as you know, but what are your sort of hopes, insights, around what we can do and where we are and where we should be.
Sure. It's like you mentioned, agriculture is a big piece in terms of global emissions. If I remember right, it was like a 1% difference between energy and agriculture on the last report. It's like 24% from energy and like 23% from agriculture. Agriculture gets very complicated because it's such a broad topic, right? You have everything from cattle to forestry to land use, fertilizer use, et cetera, are all in there. So, and then in terms of our current talk, we always talk about CO2, but the main problem coming out of farming is more nitrous oxides and methane. So those require different approaches and different technologies. And even the way we look at it, we do everything in CO2e based on 100-year timescales. But if you use CO2 on a 20-year timescale, methane is 4 times worse. So methane is a more immediate gas where CO2 is a long-term gas. So trying to find ways with trying to create more sustainable farming methods that use less water. Using less water would therefore require less fertilizer usually. You're not washing away as much into the oceans, because that's also a problem. You have the nitrate loading into your local water supplies, which creates local water use issues as well. So seeing more focus on that in terms of creating more biodiversity, more ways to create carbon credits for the farmers would be, I think, a good first step. But it needs to be done in a way that's actually creating co-benefits, not just saying, we're going to work on reducing CO2 emissions. It needs to be something that addresses the social aspects of those farming, as well as the emissions aspects.
Yeah, thanks, David. We're coming up to 4 o'clock now, so I'm just going to sort of wrap up and thank both you and Rachel and David for sharing your thoughts and views. I think we've gone through a whole sort of spectrum of discussion points. So we've touched upon social, we've touched upon environmental and governance. But I think for the sake of the audience, the sort of last piece of advice from both of you to the audience on what they as individuals can do in order to become champions of this within their own organizations. What do they need to do within their networks? David?
I get to go first. So, the best thing you can do is be active, but also be knowledgeable. This is a very, very broad topic. So just looking into, say, like the PRI and following their statements. When I started at CFA, I started here about 3 months ago. One of the first things I did was go through our whole ESG certificate just to get myself up to speed on what we were saying. And, we're in line with the PRI guidance. So if you don't know much, the PRI is a good place to start in learning how to engage and how to talk to companies and what kind of systems do you need to have in place to actually have communication, learning, and knowledge building.
Right, so the PRI is Principles of Responsible Investment.
Mm-hmm.
Great, thank you. Rachel, your sort of advice to the audience listening is,
Yeah, I agree. I think it boils down to good old fundamental analysis when it comes from an accountancy professional's point of view, and you just have to do your research, ask these questions, and these are times when it's good to raise your voice and use your knowledge and to help companies make the right decisions and do the right things. And I guess you talk about investors a lot. I do see that. With the agriculture thing, just based on what David was saying too, there is so much of the S in that. It's just so important that we really think less about our portfolios and showing off what our selection process is, and just really thinking about putting our money where it matters.
Yeah. I think it's the other thing too is you need to make sure whenever you're making a decision, you're not just thinking the short-term repercussion. You have to have the long-term horizon always in your mind. You need to be sustainable in the short and long term. If you're not making money now, it doesn't matter how sustainable you are in the future, right? So you need to be making business decisions that are good for the whole horizon of your business, not just what do I need to do to make my next annual report.
Yeah, and one thing I forgot to mention when you were talking about that earlier about the materiality is there's a woman who's a member here in the UK for Companies House, and she's just the anti-fraud queen. She was saying so many businesses and so many like even agencies that are hired to do due diligence, like credit agencies and so on, they only look 1 year back. You have to look 10 years back. You have to look at their whole history. And that was something that was a big lesson learned recently too.
Yeah, that's true. For a lot of your environmental liabilities, there is no legal time horizon. When I was doing my consulting in Boston, there was a company there that got fined for oil spill that happened 35 years ago. It's just that no one found it until then. And the company had even changed hands twice. So ExxonMobil ended up being the one getting sued. But for when it comes to environmental issues, a lot of countries have zero kind of lifespan on those. They can go 100 years back and you would still be legally liable.
Gosh, yeah. Fantastic. Anyway, thank you very much, David. Thank you, Rachel, for sharing your thoughts and your advice. Audience out there, I would say, there's no compulsion to start off with external reporting. You could spend probably 12 months to 18 months looking at internal mechanisms and then, trying to find like-minded people within your networks that you can engage with, doing a lot of knowledge gathering like David has suggested. Both CFA and ACCA have lots of material on this that you can use and develop your knowledge. And then, I think that's a good sort of anchor to start off with any future external reporting, is just to concentrate on internal MIS and seeing where that takes you. So thank you very much, guys, for joining us. Thank you to the audience. And thank you to Aruna, Radhika, and Ruchero been working in the background to get this all together. And I'll be sharing some feedback with you guys and maybe inviting you back to talk about some other interesting pieces as well. Thank you very much, everybody.
Thank you so much, Arif.
Bye-bye, Rachel.
Arif.
Bye, David.
Thanks, David. Nice
Thank
to
you,
meet you.
Arif. Thank you, David. Thank you, Rachel.
Thank you, Aruna.